Are you buying a home in Delaware and wondering whether a conventional loan is the right mortgage for you? Maybe you've heard that conventional loans require 20% down. Maybe you're comparing FHA, VA, DSHA, or down payment assistance programs. Or maybe you're trying to figure out whether your credit score, income, or property type will work. Here's the good news. Conventional loans are more flexible than many buyers expect. Hi, I'm John Thomas, loan officer here in Delaware, and today I'm going to walk you through Delaware conventional loans, how they work, who they fit, where they may not be the best option, and what you should know before you apply. A Delaware conventional loan is a mortgage that is not insured by FHA, VA, or USDA. Instead, it allows Fannie Mae or Freddie Mac guidelines. These loans are often called conforming loans because they must meet conforming loan rules and loan limits. You can use a conventional loan to buy a primary residence, a second home, and even an investment property. It's also eligible to purchase a 1 to 4 unit residential property. That flexibility is one of the biggest reasons many Delaware buyers use conventional financing. The goal of this video is simple. I want to help you understand your options so you can move forward with more confidence. What is a Delaware conventional loan? A conventional loan is a mortgage that is not backed by the government. That means it's a different from an FHA loan, VA, or USDA. FHA loans are insured by the Federal Housing Administration. VA loans are backed by the Department of Veteran Affairs, and USDA loans are designed for eligible rural and suburban properties. A conventional loan follows Fannie Mae or Freddie Mac guidelines. That means your credit, income, debt, down payment, property type, and overall file are reviewed to see whether the loan fits the program guidelines. What this means for you is that conventional loans can be very flexible, but they are also risk-based. A stronger credit profile, lower debt, and larger down payment may help improve the loan options available to you. Do you need 20% down for a conventional loan? This is one of the biggest myths about conventional loans, that you need 20% down. That is not true. Qualified buyers may be able to put as little as 3% down on a primary residence, depending on the program, credit, income, property type, and full underwriting review. For example, on a $300,000 home purchase, 3% down is about $9,000 before closing costs. On a $400,000 home, 3% down is only $12,000 before closing costs. That does not mean every buyer qualifies for 3% down, but it does mean you should not assume conventional finance is out of reach just because you do not have 20% saved. What this means for you is that a conventional loan may still be an option even if you are a first-time buyer or you have a small down payment. What credit score do you need for a conventional loan? Credit is important with conventional loans. Freddie Mac generally requires a minimum 620 credit score, while Fannie Mae uses risk-based eligibility and does not have a minimum score. In real life, most conventional loan approvals are at 620 or above, but the full file matters. That means the underwriter is not only looking at your credit score, they're also looking at your payment history, your debts, your income, your assets, any collections or charge-offs, the property type, and your overall risk profile. So if your score is around 620, 640, 660, or 680, the right answer is not always automatic. We need to compare the options. Sometimes conventional loans make sense. Sometimes FHA may be a better fit. Sometimes down payment assistance can change the picture as well. The key is to look at the numbers. PMI on a conventional loan. What is it? If you put less than 20% down on a conventional loan, you will usually have private mortgage insurance, also called PMI. PMI protects the lender, but it can help you buy with less money down. Here's the important part. Conventional PMI is usually removable as you build equity. The page explains that PMI is generally required below 20% down and can be removed as equity builds. This is one of the biggest reasons some buyers prefer conventional financing over FHA. With FHA mortgage, insurance often stays on for the life of the loan unless you refinance or meet specific exceptions. With conventional, PMI can typically come off later when you've reached 78% equity. What this means for you is that the loan with the lowest starting payment is not always the lowest long-term cost. We need to compare how long you plan to keep the home, your credit score, your down payment, and your future refinance options. Delaware conventional loan limits. For 2026, the Delaware conforming loan limit for a one-unit property is $832,750 in Newcastle, Kent, and Sussex County. The limits are higher for multi-unit properties. For example, 2 units, $1,666,250, 3-unit, $1,288,800, and for a 4-unit, $1,601,740. So if your loan amount is at or below the conforming limit, a conventional loan may fit. If you need to borrow more than the conforming limit, you may need a Delaware jumbo loan or a structure with a conforming first mortgage and a second mortgage. What this means is simple. The purchase price is not the same as the loan amount. Your down payment affects whether your mortgage stays with the conforming loan limit. Home ready and home possible mortgages. Two popular low payment, down payment conventional options are Fannie Mae Home Ready and Freddie Mac Home Possible. Both can allow qualified borrowers to put down as little as 3%. These programs can be helpful for first-time home buyers, but they still have guidelines. Your income, property type, credit profile, and full loan file all matter. Freddie Mae defines a first-time homebuyer as someone who's not owned a residential property in the last 3 years. So that's important to understand. So even if you owned a home in the past, you may still be considered a first-time homebuyer for certain programs with conventional loans, if enough time has passed. This is why it's worth having a conversation before assuming you do not qualify. Can conventional loans work with DSHA and down payment assistance programs? Often, yes. Several Delaware down payment assistance programs can be paired with a conventional first mortgage depending on the program guidelines, your income, the property, and your full profile. So DPAs are an option. This can be helpful for buyers who have enough income to afford the home but still need help with down payment and closing costs. The important thing is that the down payment assistance is not one size fits all. The best option depends on your credit, income, county you're buying in, purchase price, property type, and program availability. What this means is that we should compare conventional, FHA, VA, DSHA, and other assistance options side by side so you can pick the right one. The goal is not to just get a loan. The goal is to choose a loan that fits your situation. Conventional renovation and conventional construction loans. Conventional loans can be used in situations where the home needs repairs or where you're building a home from scratch. If a property needs work, a conventional renovation loan will allow you to finance the purchase and the repairs all in one loan. The Fannie Mae home style renovation and the Freddie Mac choice renovation are your conventional renovation options. For buyers building from the ground up, a conventional one-time close construction loan will allow you to buy the home and build it all in one loan in one closing. There are more advanced loan options, but they may be powerful when used correctly. What this means for you is that a conventional loan may still work even if the home is not move-in ready, but we need to review the property, the contract, the budget, and the guidelines carefully. Conventional versus FHA versus VA. A conventional loan is not always the best loan. There is no one-size-fits-all answer. Conventional loans can be a strong fit when you have solid credit, documentable income, and enough cash for down payment and closing costs. They are also useful for second homes and investment properties and buyers who want PMI to be removable. FHA may be a better fit if your credit score is lower or your down payment is very limited. The VA may be the best option if you're an eligible veteran or active duty service member or a qualified surviving spouse, because VA loans allow zero down and have no monthly mortgage insurance and low rates. Now, conventional do allow as little as 3% down for qualified borrowers. FHA allows 3.5% down to 580, and VA has 0% down. So does USDA. Now, we should compare your options and to see which one's going to be the best fit. Where conventional loans may not be a good fit. A conventional loan may not be a good fit if your credit score is below 620, your debt to income ratio is above 49%, or your cash to close is limited. If you're a VA eligible and VA is clearly better, you need a loan amount above the conforming loan limit, or if you're buying an investment property and need a different qualification method. For example, if you don't want to document your income, you can buy an investment property with what's called a DSCR or a cash flow loan. So instead of personal income, the DSCR loan is a much better option. So if you are looking to get qualified for a mortgage, we just need to find the right path. So Delaware closing costs and transfer tax. Delaware specific costs buyers need to understand is the reality transfer tax. The Delaware charges a 4% real estate transfer tax. And on a resale, the Delaware Association of Real Estate Contracts splits it 2% to the buyer, 2% to the seller. So again, you got to read the contract carefully, because some builders actually make the buyer pay the full 4%. And that can be a huge difference in cash to close. What this means for you is that down payment is only one part of the money needed. Closing costs, escrows, transfer tax, seller credits, and assistance programs all matter in determining your cash to close. So how do you apply for a conventional loan? Well, the first step is a short conversation. Let's take a look at your credit, your income, your debts, your down payment, your property goals, and timeline, and we can compare options. For some buyers, conventional is the best fit. For others, maybe it's FHA, maybe it's VA, maybe it's a DSHA down payment program, maybe it's a jumbo, maybe it's a renovation or construction. So we can look at all of these for you. The goal is to make the process simple and clear so there are no surprises along the way. So if you're buying a home in Delaware or Maryland and want to know whether a conventional loan is the right fit, I'd be happy to walk you through your options. Call me directly at 302-703-0727, or you can apply online with me or my team, and we'll review your situation step by step. So I'm John Thomas, Mortgage Loan Officer. Thanks for watching. I look forward to helping you move forward with confidence on a conventional loan.